Hi guys, welcome back to Father and Son Investing. Today is going to be the update for March 2023 Treasury bills. I did this back at the end of January talking about February. There are some things that have changed a little bit, so we're going to give you an update of what the Treasury bill market looks like and whether now is still a good time to get into Treasury bills. If so, what is the Treasury bill that I prefer? There may be a few of you out there who aren't familiar with what a Treasury bill is, so here's the 30-second explanation. The U.S. government borrows money. To do that, they use three different forms or three different lengths of time. If it's 20 to 30 years that they're going to borrow your money, that's called a Treasury bond that you will purchase from the government. If it is anywhere between 2 and 10 years, it's going to be a Treasury note. If it's 52 weeks or less, you're going to be buying a Treasury bill from the government. That is how the government is going to borrow their money. Now, just why would people be interested in purchasing Treasury bills from the government right now? Well, the reason is because the investment rate or the yield has been going way up recently. You can see here that starting in about January of 2022, the yields on Treasury bills just started to skyrocket. You can see the various types of Treasury bills here, anywhere between 4 weeks and 52 weeks, and we're going to narrow in just a little bit. We're going to bring this in even closer. We're going to go to October when rates really started climbing. Again, the 4-week and the 8-week. We're going to bring in the 13-week, the 17-week, the 26-week, and finally the 52-week. Again, notice this gap, this spread here between all of them. And then I want you to pay attention to how that gap, that spread started closing really near the end of January. I've updated this with February's results, and we'll see that the gap is starting to spread a little bit again. Now, the question you should ask yourself then is what was happening in January that was causing this spread to narrow, and what has been happening in February that is causing this spread to widen out again? Now, I'm going to share with you a few of the news announcements that have occurred during the month of February. These obviously are not the only things affecting how that spread is widening, but these certainly are factors that people pay attention to. So on February 3rd, the jobs report came out. Now remember, the Fed has been raising interest rates. Their hope is actually to increase the unemployment rate as well, by doing that to bring inflation down. However, on the February 3rd jobs report, the total non-farm payroll increased actually by 517,000 jobs, while the unemployment rate stayed steady at about 3.4%. So that indicates, at least when it comes to jobs, that all of these interest rate hikes the Fed has been doing is not having the desired effect, at least at the moment. Then on February 14th, out came the Consumer Price Index results. The Consumer Price Index is produced by the Bureau of Labor Statistics, and it indicated that the unadjusted inflation rate was 0.8%. I'm using the unadjusted inflation rate here because if you're an I-bond holder, that's the rate that you really care about. And that was 0.8% month to month. Year over year, we're looking at 6.4% still year over year inflation. Then on February 16th, out came the PPI, that stands for Producer Price Index. That is different than the Consumer Price Index. Think of this as the companies that are producing all the things that we buy and what they're paying for their costs. So seasonally adjusted, that came out at 0.7% month over month and 6% year over year. These numbers are running hotter than people expected, especially after those December numbers came out showing inflation looked like it was getting under control. Finally, on February 24th, the PCE numbers came out. That stands for Personal Consumption Expenditures. This is similar to CPI, but there are some significant differences. Nevertheless, it does help us keep track of inflation, and this is actually the preferred numbers for the Fed when they're looking at inflation. So the PCE numbers came out, and that came out at 0.6% month over month inflation and 5.5% year over year. All of these numbers, what have they done in the last month to the way that that spread looks? All right, in arrows, I have put the dates that each of those particular reports came out, and we'll see what that did to each of these different types of Treasury bills. Here comes the 4-week. You'll see that it actually took a little dip and then has kind of really come back to where it was. Now, just so that you know, the dates that you see here on the bottom are actually the issue date for a Treasury bill, not the auction date. The auction date is a few days before the issue date. So what does that mean? Well, that means actually that when this CPI came out, this issue date, the auction had actually occurred a couple of days before that. So what we're going to pay attention to is the next 4-week Treasury bill when it came out, and what effect did it have? We'll see that things went up just a little bit. Let's bring in the 8-week Treasury bill. We're going to notice that there it is. This gap is starting to form here compared to what it looked like earlier in the month and at the end of January. We're going to start to see a trend here. Let's bring in the 13-week. Let's bring in the 17-week, the 26-week, and the 52-week. Notice the gap, this spread here forming. What is driving this? I think it has to do with these 4 reports that I've highlighted and the way investors or people who loan their money to the U.S. government feel about the way that inflation is getting under control or not. These reports indicate that it isn't as good as it looked when the December numbers came in back in January. Therefore, investors are expecting higher yields, and these rates here are going up. Therefore, I think investors are expecting the Fed to raise their rates, and therefore they're expecting higher rates out of the U.S. government. And I think they're expecting that the Fed will do this for a more prolonged period of time instead of just one rate hike and then stopping. Therefore, they're expecting yields on these longer-term Treasury bills to go up still. Now, the question you have to ask yourself is, should I be buying a short-term Treasury bill in the hope that a month from now that Treasury bill yield will be even higher, or should I be trying to lock in a higher yield right now on some of these longer-term Treasury bills? We're going to use the past to try to help predict what we should do now. So let's go back to August 11th of 2022. The 52-week Treasury bill was coming in at a 3.3% yield, which actually sounded pretty good at the time. But we fast forward to October and we see that the 13-week Treasury bill had already caught up to that yield. And we see that going forward, the 13-week Treasury bill went up significantly beyond that 3.3%. So which strategy would have worked better? Purchasing a 52-week Treasury bill, locking in 3.3% for 52 weeks. At the time, that sounded pretty good. But knowing that interest rates were rising at the time and that the Fed plan to continue to raise interest rates. Instead, one could have purchased a 13-week Treasury bill, and we see that even before those 13 weeks were up, the 13-week Treasury bill had already caught up to the 52-week Treasury bill, such that by the time those 13 weeks were up, you're looking at 4% or more for purchasing another 13-week Treasury bill. Subsequently, planning on purchasing another 13-week Treasury bill after that, or if you saw that this spread was narrowing, then you could have locked in a higher rate for a 52-week Treasury bill or a 26-week Treasury bill. I opted recently for the 26-week Treasury bill after I saw the spread narrowing. Going back to the new numbers again, we see this spread here is occurring between the Treasury bill yields. Which is going to be the better option? Purchasing a 52-week Treasury bill at 5%? That actually sounds really good, doesn't it? Or is it going to be purchasing a Treasury bill with an earlier maturity date, say a 17-week or 13-week Treasury bill, hoping that when those 13 weeks are up, the rate for the longer maturity 26 or 52-week Treasury bill will have gone even higher? I personally like 2 Treasury bills here. I like the 26-week Treasury bill still. It's over 5% on its annualized yield there. And I also like the 17-week Treasury bill. I think that when those 17 weeks are up, that we'll find that the 52-week Treasury bill's yield will have gone up even more, and that might be a good time then to lock in the 52-week Treasury bill. Now, this may be playing with fire a little bit. A 5% yield on a 52-week Treasury bill is nothing to sneeze at, and so I'm going to strongly be considering purchasing a 52-week Treasury bill as well, just to sort of hedge my bets. I hope this information was helpful for you. If it was, please give us a thumbs up. Let me know what you think about the Treasury bills that you're purchasing and why you're purchasing them. Until next time, enjoy your investing.